So just a real quick item here. This presentation is intended for general education or informational purposes only and does not replace specific independent professional advice. The presentation is based on our current interpretations of law, which is something actually that we've been saying a lot this year in the last 18 months as a lot of these things change. So this is what we know as of now. The interpretations may ultimately change, whether it be IRS or other guidance. Statements and opinions expressed are those of the presenter or participants individually, and unless expressly stated to the contrary, are not the opinion or position of Bonadeo. Bonadeo assumes no responsibility for the content, accuracy, or completeness of the information presented. Attendees should note that sessions may be audio recorded and published in various media, including print, audio, and video formats. This session is being recorded, so we would note that. So our agenda, one of the things, make sure that you're answering polls for the CPE. So if you need CPE, there'll be poll questions throughout that you should make sure you're answering to show that you're participating. Ask questions in the chat. We've found over the last 18 months as we've attended and presented at these various webinars that there's a lot of great questions that come through the chat. So please feel free to note any of those, and we'll check periodically throughout the presentations and make sure we get back to you on your questions. Your microphones are muted and video disabled for this webinar. And at the conclusion of the webinar, you will receive a copy of the PowerPoint as well as a top 10 takeaways from our GASB 87 webinar. We've got a great group of panelists today that'll be going over each of these areas. Keely will kick us off next, and Greg following that with some ARPA items. Keely's going over some GASB updates, and then Heather and I will take you through the GASB 87 session. A little bit of who we are. The firm was founded in 1978. We are a top 50 CPA firm nationwide with over 800 employees and 10 office locations across New York State from Buffalo to Manhattan, as well as offices in Vermont and Texas. We have a full array of audit, accounting, and consulting services. However, the group that you're meeting with today are a bunch of our governmental experts. Our governmental team includes 75 professionals, and our information technology group tops 40 professionals. Who we serve over 300 governmental entities each year. Federal and state contracts, counties, cities, towns, villages, state, city, and local authorities, public schools and BOCES, and community colleges. And what we do, obviously the financial and internal audits that you think of when you think of an accounting firm. We also do town clerk, justice, and tax collector audits, information technology consulting, outsourced accounting for some of our local governments, performing the bookkeeping, but also a lot of management services as well. Assist with the implementation of accounting standards. We're going to take you through some things that need to change this year. Everyone's resources are constrained over the last 18 months. Certainly don't hesitate to reach out to us. We can help you with these items. With that, Keely's going to take us into the governmental accounting update. Keely?
Thanks, Tim. Good morning, everyone. I'm Keely Hines out of the Syracuse office. Thank you for joining us today. We are going to kick off with our first polling question. How did you hear about this client webinar? Tim, can you see that? Tim, can you see the poll?
I do not see the poll. Danielle, can you help us with that? There we go.
Now, okay.
You should see it off in the upper right-hand corner.
Okay, there we go. We've got responses coming through. All right, perfect. So while you folks answer that, you've got about a minute left, so please submit your response, and we will get started. The next A couple of slides simply outline what the GASB has been issuing in relation to implementation dates. Today, we're going to zip through 89, 91, 92, and then 94 and 96 briefly. And then GASB 87 will be the bulk of the presentation, with Tim and Heather focusing on those lease standards. And then forwarding to GASB 89. So GASB 89 is effective for this fiscal year end, 12/31/2021. This has to do with the GASB stating that interest costs incurred prior to construction period should be considered a periodic expense and therefore no longer capitalized. So previously, those expenditures were being capitalized. They no longer should be. And this GASB pronouncement should be applied prospectively, which means beginning with 12/31/2021. So the good news with this is that management will not be forced to take a retrospective look at maybe some interest costs that are currently sitting in capital assets. So you will not have to go through that process. So this will simply be taking action now and going forward. GASB 91 has to do with conduit debt. It clarifies the definition of conduit debt, and then specifically relates to what the third-party obligor and what the issuer will be presenting in the financial statements. On the next slide, we have a nice visual. Conduit debt means that there are three parties involved: a debt holder, a third-party obligor, and an issuer. So the third-party obligor is the borrower in which receives those proceeds and has the ultimate responsibility for making those debt service payments. As such, they are the individual that will then record that corresponding liability on the face of their financial statements. Again, for conduit debt, there's three parties involved, and in this case, the issuer that cannot be part of the same reporting entity will simply have a footnote disclosure explaining that they are the issuer related to this debt. Presumably, there will be no recognition of a liability at any point during the terms of this debt arrangement, unless a few specific things happen. If it becomes likely that the issuer will have to step up and make those debt payments, or that it's looking like the obligor has already defaulted or will be defaulting, in that case, that's when a reevaluation would take place, and then perhaps an issuer would have to record that debt at that point. GASB 92 is an omnibus statement. What comes with an omnibus statement is typically a wide array of topics and really clarification, all related to previously issued statements. The bulk of this particular statement has to do with the assets and the liabilities associated with pensions and OPEB plans. In New York State, considering that we can't fund OPEB plans, and there are very few instances in which there are sole employer pension plans that folks are participating in, because typically folks are defaulting to the New York State pension plan. Much of this will likely not have a large impact on those folks that are on the call today. On the next slide, there's a couple items that are included in this omnibus that relate to reinsurance recoveries and government acquisitions. Related to the reinsurance recoveries, this statement allows for you to report those recoveries as a reduction of expense. So if those recoveries were to come in, you could debit your cash and credit the expense by way of reducing the expense versus recording a revenue. GASB 69 specifically had to do with government acquisitions, as well as dissolutions or discontinuations of operations. In GASB 92, they specifically touch on government acquisitions, reminding folks that an acquiring government is obligated to record those associated assets and liabilities related to the asset retirement obligations of that government that they've taken over. GASB 94 and 96 somewhat go hand in hand in that they will be a secondary step to this evaluation that'll have to take place as part of GASB 87. So when Tim and Heather talk about how you will have to review all of these contracts and arrangements to determine if you have leases, much of what will shake out is lease arrangements or contracts and agreements that may fall within one of these two categories under GASB 94 and 96. The nice thing is implementation of both of these follows behind. So it'll be almost like a second tier implementation related to going through these arrangements. The difference between a PPP and an APA is a PPP will convey control of a non-financial asset to provide a public service. So for instance, a parking garage, some sort of facility or building in which that control is conveyed either to another public entity or a private entity. Versus an APA, a government pays an operator for services relating to operating that non-financial asset on their behalf. A lot of folks have said that this kind of looks and reminds them a little bit of the service concession arrangement standard that came out a few years back. A service concession arrangement is a type of PPP in which the operator collects and is compensated for fees that are established by that third-party user and charged to that third-party user, and that government plays a role and has the ability to modify or approve that level of services or fees to be charged. GASB 96 has to do with subscription-based IT arrangements. Basically, the takeaway here is if there's subscriptions associated with software, even hardware, all of those types of things will have to be considered for a right to use asset offset with a liability. And the standard provides some capitalization criteria for outlays that happen other than those subscription payments. So on the next slide, activities other than those subscription payments can fall typically within three categories. What's happening during that preliminary research and development phase, that initial implementation stage, and then ongoing operation or secondary implementation as needed. So during preliminary, typically that may include shopping around, determining what maybe a specific accounting software can do and provide for you. Those are considered periodic expenses and don't really feed into providing that asset extended life or enhancing that asset. During the actual implementation stage, which may mean the actual like hardwiring, implementing and rolling out the use of that software, those expenses will be capitalized as part of that right to use asset. And then depending upon what's happening after that in terms of continuing operations or perhaps upgrades or following phases as part of the rollout of a new system, they may be expensed or capitalized depending upon the impact that it has on that right to use asset. Okay. Moving on briefly to the audit standards. This is kind of a unique set of audit standards that has been released because often when those audit standards are coming out, they very much impact we at Bonadio and what we have to do behind the scenes when we are performing and providing those audit services to the folks on this call today. In this particular case, the audit standards will actually impact you folks in that the independent audit report that you're accustomed to seeing is going to look very, very different going forward. And some of that language and communication that we include in our engagement letter and communications that we have with those charged with governance will also be impacted by these audit standards. Okay, second poll question. Okay, will auditors report Will the auditor's report change as a result of these standards? Yes or no? Excellent. It looks like everyone was listening. The answer to that is yes. So on this slide, you will see what the beginning portion of our independent auditor's report will look like. So previously, you were accustomed to receiving a report that would begin with mentioning you as the client, the scope and period of the work, followed by management's responsibilities, auditor's responsibilities, and then somewhere around 3/4 of the way through the report, you would see what the audit opinion was. The standards are now going to require that opinion or opinions on the financial statements be brought to the forefront and will be the first section of the independent audit report. One of the other new requirements that you will see is that a basis for the audit opinions will be required to be included in the report. Most of you are probably not accustomed to this type of paragraph because prior to this set of standards, the only time we would include a basis for opinions paragraph is if we had a modified opinion on one or more of your opinion units. So this is really further clarifying what the basis was for that opinion, regardless of whether it's unmodified or modified. Followed by the opinion, we will include the responsibilities of management, which much will look the same as prior. The one new element to this is specifically highlighting management's responsibility related to going concern evaluation. Much of what you folks are responsible for doing is setting your budget and ensuring that you can meet your current obligations. So this is now called out specifically in our independent auditor's report as part of your responsibilities as management. Followed by management's responsibilities is the auditor's responsibility. The bullet points are a little bit more specific and expanded in terms of exactly what we're responsible for. Not much is really changing by way of what we're doing. It's just highlighting some of these things on the actual audit report. And again, in that same vein with going concern, that last bullet point includes our responsibility to consider that going concern the same as what you are responsible for. Following the responsibility sections, we will be highlighting a section on required supplementary information, and other information. Much of the language will appear similar to what you've been accustomed to, but this is really kind of nice because it'll break it out in each section for any applicable RSI, SI, and OI. A great example of RSI is the management's discussion and analysis. It's required to have those financial statements properly presented in accordance with the GASB. It is, however, unaudited, so that paragraph will continue to say, yes, this is a required component of the financial statements, but it is unaudited and we do not provide an opinion on it. Supplementary information is a great example is either the CFA, if you have a single audit, or perhaps a combining schedule of your non-major funds. Those we do provide an opinion on in relation to the financial statements. And then versus other information is how it sounds. It's other information that's included in the body of the financial statements. In the event you issue a CAFR, other information may include those statistical information spreadsheets and analyses, or it may include a schedule that management has decided to include but is not a required component of the financial statements. Again, that's unaudited, and we will disclose that we do not provide any assurance or opinion over that. Lastly, in terms of what you can expect for communication changes, now going forward in your engagement letter, you may see that we identify significant risks of where we think material misstatement may happen that we've identified as part of our audit planning. Sometimes that may be difficult to know exactly what those are at the point in which we provide you folks with an engagement letter. So we may also end up communicating with you throughout the audit through an other planning communication letter where we may highlight a newly identified significant risk or a change to that risk assessment. This will allow for you folks to know where we are spending some extra attention and where we think there is risk for material misstatement, and we will design audit procedures in response to that. Okay, Greg, I will turn it over to you so you can jump into ARPA.
Okay, thanks, Keely. But before I get started, why don't you give us a little professional background about who you work with?
Sure. So I spend all of my time working in the government arena, auditing everything from counties, cities, towns, and villages. And then I spend a large portion of my year working with school districts as both an external and internal auditor.
Okay, great. Thank you. So I am Greg Evans, and previously, before the American Rescue Plan Act, I did a lot of those same things that Keely did. But right now, I am working with 42 local governments, including cities, counties, towns, and villages. Mostly, 24 hours a day. I don't sleep. I just think about ARPA. We think about ARPA. So we're gonna talk about ARPA today. We're gonna go over some of the basics. We're gonna think about what you can spend money on today. We're gonna think about new legislation that's coming out. I know a lot of you aren't necessarily involved with local governments, but I will tell you that many of the governments I'm working with are very much in the planning stages of things, and they need projects. They need ideas on how to spend this money. So think about that as I'm going through this. If not, you can flip through some TikToks. Today we're going to do a PowerPoint, but I was thinking that someday I'm going to have an ARPA TikTok. So stay tuned for that. I'm going to work with my 12-year-old son. We're going to come up with something great. All right. All right, so the basics. What can we spend money on? Public health emergency, negative economic impacts, premium pay for eligible workers, investments in water, sewer, broadband, and infrastructure, and also reduction in revenue, which we're going to spend a few minutes on in a little bit, because that has certainly created a lot of confusion at this point. So the response to public health emergencies, there's some obvious ones up here: vaccination programs, support for isolation. A lot of these things are happening at the county level, but I have seen where towns and villages are involved in assisting the county. And, do make sure that, if you're doing that, either you're recovering your costs from the county or you're thinking about using ARPA funds for that. Again, in terms of mitigation and prevention, ventilation improvements in congregate settings, health settings, especially enhancement of public health data systems. So, there's a lot of regulations, but these regulations are fairly vague and allow you to fit a lot of things into these categories. So you really got to think about what you're doing in response to the pandemic. I've seen a lot of, especially with smaller towns and villages, create additional space in public buildings, HVAC upgrades, plastic shields, things like that. Those would all fit under mitigation and prevention. Negative economic impacts. So again, think about what's happening not only with your local governments, but the small businesses and nonprofits around you. I've seen a lot of grants go to ambulance companies who in particular are struggling at this point. We've seen hospitals not allow ambulances to bring patients in, so they're parking outside. Obviously, that decreases the capacity. And as a community, you obviously need ambulances that are able to respond. So there's been dollars spent there. Restaurants are always the classic example. I know there's been other restaurant grants out there, but certainly the pandemic has shut them down. That there's obvious negative economic impacts there. So premium pay. Moving on to premium pay. A lot of local governments are staying away from premium pay because they're having a hard time figuring out, who's eligible for this. But again, the regulations here have allowed the local governments to define what an essential worker is. I mean, what we're looking at now is we know what an essential worker is not. We know someone that's working from home, not really interacting with the public, not performing in-person work. That person would definitely not be eligible for essential worker pay. They did put some caps on that pay, not more than $13 per hour in addition, not more than $25,000 per eligible worker. And also the maximum amount before you have to have a written justification, which in most cases is 150% of New York State's annual mean wage for all workers, which is, last I checked, was $67,850. So what you need to keep in mind here is this isn't preventing you from giving someone additional pay if they're over that amount, but you need to justify it. You need to justify it both publicly and in our response to the Treasury. Investments in water, sewer, broadband, and infrastructure, anything that qualifies under the Clean Water and Drinking Water revolving funds, those are eligible projects. We've seen a lot of repairs of systems, additions to residential systems. Those would certainly qualify. Broadband is another area where we've seen a lot of activity lately. Unserved and underserved is defined as 21 megabits per second. So if you're at that range, you're eligible for this. If you have a group of people in that range, they're eligible. But the projects must upgrade you to 100 megabits per second. So keep that in mind. Okay, revenue loss. What is revenue loss? So revenue loss in general is we're comparing 2019 to 2020, and we're seeing what the revenues are across all revenue streams. You cannot pick and choose revenue streams. It's everything with the exception of utilities, which is water, gas, electric, and transit. Federal funds are excluded. So that's what the comparison involves. So in thinking about that revenue loss, after we've gone through and we've done that calculation and we're giving you that 4% growth factor, or possibly the average of the 3 years up to 2019, we're going to look at spending up until that amount. So in those spending category is now open to government services. So those other categories that we talked about, whether it's public health or negative economic impact, water, sewer, broadband, we don't have to worry about those. We're talking about anything that the government does when we're talking about government services, with a couple exceptions. And this is the forbidden list. You cannot pay debt that was existing as of March of 2020. You cannot pay judgments against the town. You cannot take the money and just drop it into your reserve funds. And you cannot use it as a local share of the federal grant. So the money does need to go out the door sometime before 12/31/2024. So that's where some of the confusion has come in, because we've heard the term a lot, revenue replacement. It's not really revenue replacement. It's just another eligible category of spending. So the key there is the money does need to be spent.
Greg, quick question.
Yes.
I've seen you present on this a few times and seen some of the questions that people have come up with. I think one of the big confusion items is, when do they record the revenue for this revenue loss?
Okay, that's what we're getting to, Tim. Next slide. So when you receive the money as a local government, you're going to record it in your general fund as cash and the liability. As you identify and actually make those expenditures, and especially with revenue loss, it's not until the money goes out the door. So, Tim, to your point, we have had a lot of questions about, oh, you know, this is just revenue replacement. Well, it's not revenue replacement, so we're not recording it until we spend that money. At that point, you know, we'll be debiting that liability and crediting that federal revenue. If the revenue, if the projects are in other funds, at that point, we're going to do an interfund transfer. We're either going to transfer it to capital projects or possibly the water fund, sewer fund, wherever those expenditures are. So to make those other funds whole. There is a new bill in Congress that I'm going to spend a couple minutes on. But one thing I wanted to note right here, though, is for the first time, we're seeing a little bit different language. They're talking about supplementing, not supplanting revenues. So again, the idea here is this is a stimulus package. They want the money to go out the door. They don't want you to just, you know, replace your tax dollars with this money. They want it to be in addition to that. So that's key here, because there's been a lot of confusion about that. So again, supplement, not supplant. All right, so is Congress rescuing the rescue funds? Right now, the Senate unanimously passed a bill that will allow local governments to allocate up to $10 million in that category of government services without doing that revenue loss calculation. So this is huge, especially for some of our smaller governments that maybe didn't have revenue loss because of timing, and they've been struggling to try to get expenditures or find projects in those other categories that maybe they don't spend a lot of time in, whether it's water, sewer, or public health response. That's not generally what towns do, and I think Congress is recognizing that at this point, and we're assuming that the House will pass this bill, since again it does have bipartisan support, sometime in the next couple of weeks. So we will keep you updated on this. Other categories that they're allowing there that will likely help some of our counties and cities more. 10 million or 30 million of your ARPA allocations can also be used for different infrastructure projects that involve either federal surface transportation laws, which is again a very broad category if you go and Google that, or housing and development, or housing and community development projects, which again is geared at revitalizing some of our communities that have suffered. The last thing they're going to allow funding for is emergency relief from natural disasters. We know FEMA does a lot in this category, but at some point in time, they do come up short. And this will, again, free up more of those ARPA dollars for those type of projects.
Greg, we had a quick question about whether ARPA regulations are final yet.
So no, they are not final yet. We are still in the interim phase. All indications seem to point to sort of less restrictions more than more restrictions. So, and one of the things that the Treasury has said, that if you've spent money on things that are eligible under the guidance right now, they're not going to attempt any sort of clawback or anything like that. So you're good if you're following the current regulations. But again, this new bill in Congress will certainly free up some additional dollars, and I would anticipate that the final guidance will come shortly after that bill is passed. Okay, so some important dates to keep in mind. So the project and expenditure report that was previously due October 31st for everyone, and that would have been the first report due for towns and villages, is now due April 30th for towns and villages and January 31st for cities and counties. It would appear, based on everything that I've seen, that the Treasury just wasn't ready to accept all those reports and get everyone online. So I would anticipate that there'll be additional guidance coming out for that within the next month or two. Just a reminder, all of your funds must be obligated by December 31st, 2024, and completely expended by December 31st, 2026. And these are for eligible costs that are incurred after March 3rd, 2021. So we can't go back in time and try to fund costs that occurred before that. All right, we're on to poll question number 3.
Hold on one second.
Okay, so this is a great poll question. I don't know who developed it, but are consulting fees to hire Greg Evans an eligible ARPA expenditure? What do we think? So yes, it is eligible for Greg Evans and other qualified consultants out there. The Treasury has specifically stated that you can use that. You don't even have to fit it into your government services category. You can fit it into one of the other 3 in terms of helping you spend your dollars. So use your ARPA dollars if you need some help. Okay, so after we've done all this, we have to think about whether we need an audit or not. If you've spent over $750,000 in federal expenditures for the year, then you will need an audit. If you only have one program, you can use what we call a program-specific audit election, whereas we are looking at just the federal program and not the local government as a whole. Obviously, this is less in scope, less painful. We would recommend this if possible, but many times you do have, even if you just have 2 federal programs, you will need the full single audit. And that audit will be performed in accordance with uniform guidance. The second bullet there, I'll spend just a couple minutes on, again, when we read these regulations, they're pretty vague. So you have to really think about, all right, how can I spend these dollars and how do these dollars relate to the pandemic? And really what we're telling our clients to do is document that thought process, get it in a memo, think about all the things that you're trying to accomplish with this and why you're trying to do that. Obviously follow your normal procurement processes and take this memo, include it with the legislation that you're presenting to your boards, your legislators, and everything is out there. All right, so a couple of the compliance highlights, cash management. So if you're not spending your money and you are earning interest, that money is yours to do what you want with. This is very different than most of the federal programs we see where you're not allowed to do that. But in this particular case, you might be able to earn a few dollars of interest, probably not a lot, but that money is unrestricted. If you're buying equipment with these federal dollars, like any other federal program, you should inventory that on an annual basis and make sure you're tracking those equipment lists. Another question that we've seen a lot of, subrecipients or contractors, when we're thinking about how we're spending these dollars, we look at obviously, if you have a subrecipient, you have much different responsibility than if you're just simply acquiring goods and services with your ARPA funds. Some of the things that sort of guide us as to whether it's a subrecipient or a contractor, who's determining eligibility, who's making those programmatic decisions. Are you asking the sub-awardee to share in the costs of a program? We see this a lot with counties passing through money to towns and villages for Main Street projects. We've seen a lot of that. They will, if you're asking them to do a 50-50, 70-30 split, they are a subrecipient, and you will have some responsibilities related to that. Contractors are generally just people allowing you to carry out the decisions that you've already made. So,
Greg, before you move on, if I can just interrupt you with a quick question.
sure.
So we have a question that says, we received an email that counties under 250,000, which I think maybe she meant over 250,000 and less than 10 million, reports won't be due until April 30, 2022. And the question is, are you sure that counties will still need to report January 2022?
Yes, to my understanding, counties are due January 31, 2022. But I will verify that and see if there's any slight nuances there. Okay, so as a pass-through entity, what are your responsibilities? You do need a subrecipient agreement where you're identifying the award, including the CFDA number or assistance listing number, which we're referring to it as now. You do need to evaluate that subrecipient's risk of non-compliance. If you may want to consider imposing some conditions that you're expecting them to meet, and you monitor those compliance with those conditions, and also let them know that if they are expending more than that $750,000, you are expecting them to get a single audit, which is required by law, and remit that to you so you can review it and make sure that those dollars that you have passed through to them are being spent appropriately. Okay, so that was the very fast look at ARPA. Again, stay tuned to the news. I think things are going to change relatively quickly now, and we're going to be able to spend money much easier.
Greg, before we transition, we
Sure.
had one more question come through. Are ARPA dollars available to a BOCES? And if so, can funds be used to expand advertising or enhance programs where the BOCES experienced a big downturn in participation? I'm assuming what they're alluding to is as a result of COVID.
Yeah, so again, all of our local governments can pass through money to other local governments, to districts, to BOCES, and educational funding is available through that. So, Tim, is there another way that BOCES would be able to benefit from ARPA?
Yeah, that's interesting because I hadn't thought about that way of looking at it, Greg, but I agree. If you can receive, and I know some of our BOCES do receive monies from local governments to support their programs. So directly, BOCES is one of the few entities that seem to have gotten left here. We do quite a few BOCES. I see quite a few BOCES online right now as participants as well. And they did not receive the ESSER. They did not receive GEARS money, no direct ARPA money, no CARISA money. The only thing we really saw BOCES receiving relative to at least directly, relative to these types of funding is if you do have an LPN or dental program and you have student financial aid, you received HERF money. So there is that. But that's about it directly. But that's a great thought, Greg, on the indirect from the local governments, that you certainly could reach out to some supportive local governments to see if some of those funds could be passed from their ARPA funds to you.
Yeah, I would go ahead and put a proposal together, and definitely indicate how you've suffered from the pandemic and what your needs are. The worst they can say is no. So, but again, a lot of our local governments are very much in the planning phase of this funding source.
Absolutely. Great. Well, thanks, Greg, and Keely. Greg's done a great job with these ARPA funds. As you could tell, they're ever changing the rules. So we as a firm had made Greg the point person so that we had somebody that was staying on top of it day in and day out. He's a great resource. So, you know, if you're looking for assistance with your ARPA funds, as Greg said, he's doing 40 some of them. He's thinking about it day and night. You know, he's a great resource. So again, thanks to both of you. We are going to take a short pause here, about a 10-minute break, and then we're going to get into GASB 87 leases. I would ask during the break, and I do see, you know, people have been using the chat, so that's great. Continue to do that. One thing I'd like you to think about is in 2022, we anticipate doing a lot more of these presentations, and we'd love to hear feedback from you in terms of what types of programs, what are you interested in? So if you think about it during the 10 minutes that we're off here, you know, chat us through some ideas of things you'd like to see in upcoming sessions. And then when we return, Heather and I will take you into the GASB 87 leases. So it's 9:48 now. Let's say we'll get back at 9:58 and start up with the leases. Hello, folks. It's 9:58. We're just going to give another minute for everybody to get online, and we will. Hey, everybody. Hopefully, we have everybody back. We're going to get started now with Heather and I on the GASB 87 leases. First, Heather, can you just give a little background on your experience and who you work with?
Sure. I'm Heather Briggs. I'm a principal in the New York City office. I do much of the same as Keely, consult with and audit, you know, anywhere from cities, towns, counties, villages, school districts, BOCES, and community colleges. And I've probably been doing this for a long time, and I'd rather not say how long because I don't want to reveal my age.
Well, you know, I guess time flies when you're having fun, right? In the public accounting.
Absolutely.
Great. Thanks, Heather. So I'm Tim Doyle. I'm a partner out of our governmental group in the New York City office as well. Both Heather and I are missing this morning the grand opening of our brand new office on 1040 Broadway. As we move from Madison Avenue, we were not able to make it today due to the presentation, but we'll be checking it out very soon. My experience, I have been, actually, this is my 30th year in public accounting. It's been fun all the way. That's why the time flies. I do serve similar clients as the rest of our folks here, with the addition of some states, state of Connecticut we work with. We have a large contract with, work on a lot of counties, cities, towns, villages, a lot of BOCES, community colleges. So a good mix of various different types of governmental clients. So as we get into the leases here, let's see if I got the button the right way here. It was working during the break. I'm not moving the slides right now, Danielle, if you can. Greg, do you still have rights? I think it was given to me a minute ago, but.
Yeah, I think you should be good, Tim. Just click on the box, maybe. Now you're muted, though.
You're muted now.
The wrong button. All right, good. I think we're good now. You can hear me. You can see the slides. All right, excellent. So we're going to go over an overview of the GASB 87 leases. We're going to go over various examples of you know, what you need to record, what type of disclosures you have, what is considered a lease under this new standard. And a couple of things that I just want to point out, and we'll come back to them during the presentation, but I want to make a point and emphasize here. First of all, you'll see that the requirement is to apply this retroactively to the most recent, or the earliest, I should say, year presented. So for any of you that have multiple year presentations, so you're showing 2 years, now that doesn't include the MD&A, just talking about your actual financial statements. If you're showing comparative statements, you actually have to value these leases 3 times, because you've got to value them at the very beginning of the first year you presented, at the end of that year, and at the end of your current year. So neither GASB 35 nor GASB 34 require you to have multiple year presentation. I know we see it in some instances at our community colleges. Most of our other entities, we don't see the multiple year presentation. You're not required under any of the standards to have multi-year presentation, but if you do, it's another thing to think about, that you've actually got to value these 3 times. And if you're a standard 1-year presentation, you've got to value the opening inventory, or not inventory, the opening value of the leases and the ending value of the leases. So you sort of have to do it 2 times, okay? And we'll get into that more as we go through the slides. The other takeaway, BOCES, I see we have a lot of BOCES online today. One of the things to think about, you recently this year had some interaction with the state with regards to your annual report, your SA 111, and changes that were being made. I think this discussion has to be had with them very early. You are going to be required to implement this with this current year end that you're in right now. And I think there are going to be changes that need to be addressed. One of the things we see is that in general, using an example of about $100,000 lease, a 5-year lease that a BOCES has will take on about 60% more revenue in the first year of that 5-year lease than it would have under the old reporting. About 10% more in year 2, about break even in year 3, and then conversely the other way in years 4 and 5. So there's some timing there that's going to affect you in terms of your reporting. And that is at the fund level or a less or. Okay, so we'll get into some of those details. The other thing I just mentioned really quick too before we go ahead, 4 areas here that you need to be thinking about. And most of school districts and community colleges, you've already started the year where you have to implement. Any December 31st, January 1st, that's the beginning of the year, you're going to have to implement this. You don't want to wait. You have to compile and get all the terms of your leases. You've got to value those leases. You've got to do the accounting for those leases. And you've also got to do the disclosure for those leases. So there's a lot involved here. You know, we just came off of helping a lot of our clients with GASB 84. Those that acted earlier had a better year-end closing than those that acted at the end. So I would just say you want to address this right away. All right, so overview of GASB leases. It was adopted to improve the relevance and consistency of financial reporting of governmental leasing activities. They felt that not all transactions that they felt were leases were really being picked up in that manner. So they wanted to develop a standard to describe and define what leases were and how they should be recorded. It's effective for fiscal years beginning after June 15, 2021. That was actually earlier, but with the pandemic, they pushed it 18 months. So you've got June 15, 2021. So if you're a school district, you've already started that year. If you're a community college, the beginning of your year is September 1st. You've already started that year. And then December 31st will begin this upcoming year here. Retrospective application is required for all prior years. So it's what we were talking about earlier. If you're presenting more than 1 year, you've got to go all the way back to the beginning of that first year that you're presenting. All right, so the definition of a lease. It's a contract that conveys control of the right to use another entity's non-financial asset, the underlying asset, as specified by the contract for a period of time in an exchange or exchange-like transaction. So you've got an asset that either you're letting someone use or you're using somebody else's asset, for a period of time and you're providing, it's an exchange-like transaction, you're providing compensation for that. The contract could be in writing or verbal if legally binding. The right to obtain present service capacity from use of the underlying asset. And number two, right to determine the nature and manner of use of the underlying asset. Those determine your control. A non-financial asset, anything but a financial asset, is defined by GASB 72, which are investments. Non-exchange transactions are automatically excluded. So again, are you giving something to get something, and it's the use of someone else's asset? All right, so we've got a poll question number 4. And Heather or Keely, can you bring up that poll question?
There you go.
Fantastic. So does the leasing standard apply to lessors and lessees? And you've got a few options there. We'll give you a minute or so to record your answer. Again, you want to make sure that you're putting these poll questions in if you need CPE. All right. And you can continue to put your answers in as I move to the next slide. So leases, no classification of leases into operating or capital anymore. These are all considered financing leases. Okay, so you historically had operating leases, which had just flowed through your income statement. And then you may have had capital leases where they were on your balance sheet as well as your income statement. No longer, the terminology is no longer operating or capital. They're all considered financing type leases now. So the exceptions for the lessors, leases of assets that are investments, okay, and then certain regulated leases. An example is airport or airline agreements. There are certain regulated leases. Exceptions for both lessors and lessees is short-term leases, which we'll get into what's defined as a short-term lease. It's a little less intuitive than you might think. Because there's a lot of analysis that needs to go into whether or not you may or may not extend those leases. And then leases that transfer ownership and do not contain termination options. So at the end, you're going to transfer ownership over. All right, so some lease scope exclusions. Intangible assets, so mineral rights, patents, software, copyrights, they're not included in this. Biological assets, timber, living plants, living animals, inventory, so if this is for resale as part of your services, that's not, that's considered inventory. Service concession arrangements and supply contracts, such as a typical power purchase agreement, which do not convey the control or the right to use the underlying power generating facility, but the supply of the actual power. Okay, so these are the 5 items that are excluded from the leasing standard. So we've got an example here, scope and applicability. So a government enters into a 5-year agreement that provides another entity with the right to use the government's land. The other entity plans to use the land for hunting and is the only party that is allowed to access and use the land during hunting season each year for the term of the agreement. So is the hunting rights agreement a lease? So yes. So there's one of the tricky parts you look at. It's not a full year. The contract conveys control of the right to use an underlying asset, which is the land, right? So that is the land of the lessor. They're allowing someone to lease the use of that land. The period of time is specified, hunting season, and does not have to be uninterrupted. So it doesn't have to be, if it's for a period of over 5 years, it doesn't have to be every year or every day of that 5 years. It's a specific time, but it is over the course of multiple years. All right. Heather will take us through some of the common examples of leases now.
All right, some common examples of leases. You have some easements, cell phone towers, vehicles, building equipment. Some of these are very common, your vehicles, buildings, and equipment. Your cell phone towers, it's really not about the tower itself. It's about the use of the land. That's the asset that you're getting the rights to use. Buildings, if some school districts and BOCES that are out there, if you are leasing space to do educational services from other districts, you might want to look into those and determine whether they fall under the scope of this GASB. Equipment, Tim mentioned the BOCES before, and there's lots of installment agreements that they have and such. So it could be, a lot of information that you have to go through to determine, what are leases. So what's the lease term? It starts with the non-cancelable period, the period, which you can't cancel the right to use that asset. And it's covered also by the lessee's and lessor's option to do the extension of the lease. If the option is reasonably certain, if there's a high probability of that being exercised, or termination of the lease if the option is reasonably certain of not being exercised. What's excluded in this term? Periods of which the lessee and lessor both have the option to terminate, or both parties have the agreement to extend. And what's key there is that both have the option. If one or the other has the option, it's not excludable. Both have to have the option to do those things. And then fiscal funding cancellation clauses, ignored unless reasonably certain of being exercised. And that's a clause that makes the continuation of a contract subject to future annual appropriation.
Yeah, and some of the leases we've looked at here, because we've asked clients for examples of some of their leases too. When you're putting together this part of it, where you're compiling these leases and determining how long they will actually be when you're valuing them, you have to not only look at whether there are options in there, but what's the likelihood that the option will be exercised or not exercised. Some of that comes from past or history as well. You can't necessarily say, well, we don't know that we're gonna do that option, and so we don't want to include those years in there. If first of all, if the history has been that you have extended it, you've got to have a pretty good reason for why you're not. And then also, what's your plan if you're not going to extend it, right? Are there going to be other leases, and or are you going to make purchases? So there's a lot of thought that goes into that part of valuing it in terms of what is the actual term of the lease. And then just to echo something Heather said there too, when both parties have the right to extend or not extend, the standard says that that's basically a rolling month-to-month lease because it could end at any time.
So let's go through a quick example for a lease term. So a contract provides that the government control of the right to use a bus for 3 years. And then after 2 years, the government can terminate that lease. The government is reasonably certain that it will not terminate the lease. And after 3 years, there's an option to extend for 2 years. The government is reasonably certain that it will extend the lease. So what is the lease term? You can put that up in the chat. I'll give you a couple minutes.
And Heather, just while we're waiting for some answers, I see in the chat we had somebody that had some difficulties getting on. They were asking if they could get a copy of the presentation. So we did mention at the beginning that we will be providing a copy of the PowerPoint following the session. What I did not say, but I'll let everybody know now, the session is being recorded. We will also provide everyone with a recorded session as well. So that'll be after we finish the session. Our folks will put that together and get it out to everybody. So you'll get top 10 takeaways of GASB 87. You're going to get a recorded session as well as the PowerPoints.
All right, let's move to the answer. I know everybody's waiting in anticipation. All right, so there's 2 steps you got to do here. First, you want it to determine the non-cancelable period. So in the example, it said after 2 years, the government can terminate the lease. So the non-cancelable period, that first 2 years, that's going to be what you're going to evaluate first. So right now you've got 2 years. Step 2, now let's assess the options. Is it reasonably certain that the termination option will be exercised by the government? Well, if you read the question, it says the government is reasonably certain that it will not terminate the lease. So no, it won't terminate. You're going to add year 3. The second step of step 2, is it reasonably certain that the option to extend will be exercised by the government? And in the question, it says that it is reasonably certain that it's going to extend. So if it's reasonably certain, you're going to add those 2 years. Your total lease term for this example is 5 years. I think we got a poll question coming up next. Poll question 5. Give me 1 second. It says let's see, open this poll. I actually can't read that.
I can read it, Heather.
Can
if
you?
Yeah.
Sorry.
That's just because you had a tough day yesterday afternoon, but it says,
Hey.
it says your presenters represent a diverse fan base of today's NFL teams. Which one of these teams have the best chance to win the Super Bowl this year? A, Buffalo Bills, B, Chicago Bears, C, Las Vegas Raiders, or D, Philadelphia Eagles? And yesterday just changed that so much, I think.
That's why we play the games. That's what I said yesterday.
I am a big Bears fan. That's not necessarily a good thing over the last 30 years, but I will say we're the only team that I think that didn't lose yesterday.
I actually think there's way too many Buffalo Bills fans on this All right, so while we're having fun with that poll question, I'll quickly go over short-term leases. A lease that at the beginning of the lease term has a maximum possible term under the contract, including any options to extend, of 12 months or less. Practicality exception for short-term leases. For a lease that is cancelable either by month to month, the maximum possible term is the non-cancelable period, including any notice period. And for short-term leases, there are going to be no balance sheet impact, no disclosure requirements. It's going to flow through your P&L just like it normally would as an expense. So here's a short-term lease example. A government enters into a lease with a 6-month non-cancelable period and an option to extend for another 12 months after the non-cancelable period. The government is not reasonably certain that it will exercise the option to extend and therefore assesses the lease term as 6 months. Is this agreement a short-term lease under GASB 87? Short answer to the short-term lease example, no. Paragraph 16 of 87 says the short-term lease has a maximum possible term under the lease contract of 12 months or less, including the option to extend. So in the question, it said it's 6 months with an option for 12. So you've got 18 months. It doesn't matter whether they want to exercise that option or not. It's still going to be included in that determination. However, you're only going to look at that term in a 6-month period. So it is a long-term lease with a 6-month term.
Yeah, so that's a tricky one. And actually, there's a couple of things that we'll highlight throughout that seems sort of counterintuitive. But, we talk about valuing to the extent of including your options if they're going to be exercised or not exercised. But in this instance, it's pretty specific in GASB 87 that in considering whether it's a short term or not, you have to look at the possible options regardless of their probability to be exercised. seems sort of counterintuitive with some of the other valuation models in the standard.
Another polling question. Open the poll.
Looks like they wanted to get them all out of the way at the same time.
Okay, so it says, what is the lease term? A town enters into a 12-month non-cancelable lease in which the lessee can renew for 12 months at a time up to 30 times. Is that what it says? This is awful small. In the agreement, a short-term lease, is this a short-term lease under 87? I think we need to talk to the individuals who create these polls and make these a little bigger for, us to be able to read.
No, I think it's just our eyesight's getting worse.
Thanks, Tim.
All right, I think this would put my area, right, Heather?
Yes, it is.
All right, so leases within the financial reporting entity. So I think on our schools and our BOCES, they don't really deal with this too much. Our community colleges, our cities, towns, villages, in some cases do. Having component units as part of your reporting entity. Okay, so financial reporting entity includes its blended and discretely presented component units. So these are related type entities that you've done some analysis and determined that they should be part of your reporting entity. And there are two types of presentation for component units. A blended component unit in the primary government's financial statements, a lease with a blended component unit is consolidated and eliminated. If the blended component unit has separately issued financial statements, the standard applies and the lease would be recorded in the separately issued financial statement. So when you have a blended component unit in a governmental entity, you actually blend it into the funds. So it would be part of the fund presentation of that entity. If you have a discretely presented component unit, you actually would show a separate column for it and show it by itself. So what they're getting at here is that if you have a blended component unit, so you're going to pull that into the different types of funds that you have, that you do not have to, I should say, you would eliminate it so that you would not be showing both the lessor side and the lessee side on the blended component, because you're putting it all together within the government that has the transaction and the other side of it, the other component unit. So you'd eliminate that and not show both sides of it. What they are saying here also is that the standard still applies if the component unit has a separately issued financial statement. So they would still have to present it in their financial statements as either the lessor or the lessee. But then when you bring them in, you would eliminate it in your financial statements. If they're discretely presented component units, so they have their own column in your financial statements, it's treated the same way as if they were a third party. Okay, so you would treat them no different than any other entity. If they have a lessor or a lessee, receivable or payable on their sides, you would have the alternative on your side. You'd both show them, and you'd show it in both places in your financial statements. So that's sort of the treatment between whether you blend it or discretely present. So we have some examples here. Table number 1, a primary government leases a building to a discretely presented component unit. So again, this is discrete. So this is separate column in the primary government's financial statements. So the primary government would show the lease receivable. The underlying capital asset is their building in this example. There's no liability, but they do have a deferred lease revenue, a deferred inflow of resources. On the discretely presented component unit, they would have a right to use intangible asset. So this is, they have the right to use your asset. They would show that as an asset on their books. They have no underlying capital asset, as they don't actually own the asset. And then they would have a lease payable to you and no deferred inflow of resources. Okay, in table 2, A primary government leases a building to a blended component unit in the primary government's financial statements. So they're saying, how would you show this in their financial statements? No lease asset, underlying capital asset was the building, no liability, no deferred inflow, and on the blended component unit, the same. So really what we're saying here is they net all those things, okay, because they're being reported as a blended component unit, they're part of those financial statements now of the primary government. And so they eliminate all of those and you wind up just with the building. There's no lessor revenue, there's no lessee expenditures, liabilities, it all just gets netted back. So it really comes down to what type of entity are you? And you know, if you have component units, you have to do that exercise each year to determine what level of control you have on the entity, how much they're reliant upon you, and then based upon those things, you determine whether it should be a blended or a discretely presented component unit. But you can see in these two tables how different that would be. You've got a lot more to record where they're discretely, and then you have to make sure that you eliminate them properly when they're blended. So an example of some of our types of entities that we have, you know, if you have a county or a city that maybe has an IDA that's attached to it, or something like that, or a task, or different types of component units that we see that get blended in, you have to think about how is the accounting treatment here? Are they going to be blended or discretely? Okay.
All right, so accounting for these leases, and I found this very interesting actually when I was, you know, going through all of this. Initially, remember it's retrospective. You're going to have a prior period adjustment in the first year you do this, but this really speaks to what you're going to do on an ongoing basis, whether you're the lessee or the lessor. So the lessee, you're going to have an intangible asset or right to use the underlying asset. The value of the lease liability plus prepayments and any initial direct costs or ancillary to place this asset in service. And the liability piece of it is going to be that present value of future lease payments. And this includes, you know, fixed payments, variable payments based on indexes or rates, reasonably certain residual guarantees. And this is basically on the government-wide level. On your fund level, you're going to record that right to use as an expenditure, much like you do with debt payments. It's going to be, you know, it's considered financing. So you're going to expend that right to use, that cost. And then you're also going to record the lease liability as an other financing source, much like you would proceeds from debt. The lessor is going to have a governmental fund and a government-wide recording of this, almost exactly the same. So you're going to have a lease receivable, including the same as the lease liability. So it's going to mirror that value. And then you're going to have a deferred inflow equal to the lease receivable plus any cash received up front that relates to a future period. And then on your government-wide, you're going to continue to report that leased asset on there and continue to depreciate that asset. It's going to stay on your books, but you're going to add this lease receivable and this deferred inflow. So subsequent years, and this really is for that asset or that lease that you just valued, not for any new assets. If it's a new asset, you're going to, you know, value that and add that, much like on the previous slide. But for going forward, for the lessee, you're going to amortize the intangible assets over the shorter of the useful life or the lease term on your government-wide statements. And your liability, you're going to reduce by the lease payments that you make, less any interest expense that they're going to expense through your government-wide statements. The lessor is going to depreciate the leased asset unless it has an indefinite life or required to be returned to its original or enhanced condition. And you're going to reduce the receivable by the lease payments and less the payment needed to cover accrued interest. then you're going to recognize the revenue over the lease term or in some systematic or rationale manner on your both fund and your government-wide statements, not the actual depreciation of that asset, the actual asset, but the lease asset and the deferred inflow.
Yeah, but just give it a quick example of that. You know, what I referred to before with the BOCES leases being an example of, if you had $100,000 lease over a 5-year period of time at say 5% interest, we pulled that off of a recent lease. What you would experience in year one is you'd put the $100,000 on as a lease receivable, the lessor would, the BOCES, and they would also show a $100,000 deferred inflow. So at the very beginning, inception of the lease, no income statement effect, they just put that on the balance sheet. Total receivable for the lease and a total amount deferred inflow of the resources. Now you go ahead and you receive a payment, and the payment at that 5% would be about $22,500 roughly. And normally that would be your revenue that you would record, is whatever your payments were, okay? And each year you're going to receive that amount from the amortization schedule of $22,500. You would reduce your lease receivable by the principal amount, okay? So that would reduce the lease receivable, and you'd also record interest revenue on that lease, okay? In this example, the interest revenue was $4,000. The last step you would do then is you amortize the deferred inflow, that $100,000 that you put out there, and 1/5 of that over 5 years would be $20,000. So in that example of that $100,000 lease, you've got $20,000 of lease revenue from your amortization of the deferred inflow, a little over $4,000 of interest revenue, so about $24,000 or so. Going back to the cash payment of what you historically would have received as revenue or shown as revenue, it would be about $22,500. So you can see you've got about $1,500 more in revenue in year one. And that's based upon a $100,000 lease. Obviously, the larger leases, or if you have a lot of leases, it can wind up being a pretty significant amount. But the key there is you've got about 160% of what you normally would have received. So 60% additional revenue. In year two, it goes down to about 10%, and you're about break even in year three. Okay, so there's definitely some timing that needs to be thought about. And when we talk about not waiting until the end of the year, this is one of the important things we're talking about. Is you're going to have, if you're a lessor, the GASB actually has, this is another one of those things that doesn't seem intuitive. If you're a lessee, no real change to how you're booking things on your fund financial statements. But if you're a lessor, you've got to record it in this way, and there could be some timing issues. At the end of the 5-year lease, it's going to be no different. You're going to show the same amount of income, but there are timing differences here that you need to think about. Leases with multiple components. This is another thing that we see. Some of the leases that we see have separate parts to the lease. Well, they don't show them as separate parts. They're embedded in it. But when you look at the terms, there's a use of an asset that you're being charged for, and then maybe there are additional things like an admin fee or a assistance throughout the term of the engagement or the contract to assist with software, hardware, things like that. Those have got to be split out from the component of the lease. So you're really only showing as part of the lease the use of the asset, of the underlying asset. So that's another consideration when you're going through all these leases to compile what is my opening balance, what is my ending balance. There are a lot of things to consider. As Heather mentioned, you're looking at, what is the ultimate term of the lease, with potential extensions. Also, the lease that I'm looking at, when I look at the lease, are there things in there that aren't use of an asset? There may be additional administrative fees or things like that. Those are going to be pulled out of the agreement. So allocate consideration to multiple underlying assets if service components of the contract, differing lease terms, are in differing major asset classes for disclosure. So you have to break these types of things out. So for instance, if you have a lease with, let's say, buildings and equipment in it, you do need to break those out as major asset classes and say this is actually sort of two leases, if you will. Consider contract combinations when reviewing multiple components. So when you disclose all of these and when you account for them, you can aggregate them in similar types of assets. So you'll definitely want to consider that when you're looking at all of the leases that you have. You don't have to provide an accounting adjustment for each lease and a disclosure for each lease. You can aggregate them and put them together if they're similar type components and leases.
Tim,
Yeah,
there was a question in the chat.
Yeah, I just saw that. So,
Okay.
has New York issued the account numbers for these new accounts? I didn't know this was comedy hour. We all experienced with, and I'm sure many of you on the call as well, GASB 84. The account numbers came out very late, and there are still to this date account numbers that maybe need to be added, and the state's identified that and will be updating it. I have not seen anything, and I'll just ask my fellow panelists as well if they've seen anything, but I have not seen anything from New York yet on those account numbers yet. Has anybody seen anything come through for 87 yet? No.
Yeah,
Go ahead, Greg.
I was just saying not yet. I mean, for 84, it took a while, so I'm assuming this will be the same.
Yeah, and unfortunately, I mean, when we talked about it earlier as well, that this standard was moved out 18 months because of the pandemic. So really, we probably should have had them a while ago, but no, we have not seen anything yet with regards to those numbers. And, we'll certainly let you guys know when we hear it. I got another question here. If a BOCES turns over ownership of the underlying asset, technology equipment, at the end of the contract term, are those contracts considered leases with the component districts? You'd have to do actually, let me read that a little slower because I sort of read it fast there, but if a BOCES turns over ownership of the underlying asset, so let's say technology equipment they give as an example there, at the end of the contract term, are those contracts considered leases with the component districts? So I think you have to do an analysis on it. But one of the things we did talk about earlier, right, is if it transfers ownership, that's not considered a lease. But you really have to look at the contract and see how it's worded, how the ownership is being transferred. But yes, I believe if you were to transfer the ownership, then it would fall out of this leasing standard. But you definitely have to do some careful analysis on that. All right, we just got another question here. Let's see. Okay, they just like the question. Okay. All right, so back to leases with multiple components. Again, this is part of what seems sort of simple of accumulating all these leases and putting them in a list and all that. There's a lot of nuances here. So multiple components can include a lease component, such as the right to use a building, and a non-lease component, such as maintenance services for the building. In that case, the government should account for the lease and non-lease components as separate contracts. So you break them out and you say, how much of this is for the building? How much is for maintenance? If a lease involves multiple underlying assets and the assets have different lease terms, the lessor and lessee should account for each underlying asset as a separate lease component. So again, you might have to break that out as well. I think most of what we've seen, whether they be fleets of vehicles, equipment, buildings, they tend to be separate. I haven't seen a whole lot of this where we see unlike things grouped in a lease. But the point here is if you do, you got to break them out. First of all, are they non-leases? So if they're maintenance and things like that, you got to break that out. And then if they're different types of underlying asset, you got to break them out. The government, we give an example down here. A government leases 2 floors of a building. Part of the lease payments cover the government share of utility costs for maintaining a lobby that all tenants share, should the utility cost be included in the lease liability. And if it is practicable to separate the utility costs in the contract, the utility cost should not be included in the lease liability calculation. So the extent that you can determine that, you should pull that out, separate component, should not be part of the lease of that 2 floors of the building that you're utilizing the utilities for this separate entity or separate space, I should say. All right, another example here, contract combinations. Contracts that are entered into at or near the same time with the same counterparty should be considered part of the same contract if either of the following criteria is met. So first of all, the contracts are negotiated as a package with a single objective, and the amount of consideration to be paid in one contract depends on the price or performance of the other contract. So the example we give here, a government solicits bids for a fleet of public safety vehicles and leases the assets for the lowest qualified bidder. A separate lease agreement is issued for each vehicle. Can these lease agreements be considered part of the same contract if there is a single objective, the objective of which is to obtain this fleet of vehicles, right? Yes, contracts that are entered into at or near the same time with the same counterparty be considered part of the same contract if negotiated as a package with a single objective. Okay, so yes, they can be separate, but you can put them together here as one type of contract. We have a poll question number 7, I hope.
I think Danielle's going to have to launch that one for us.
Okay.
Do you see it? Okay. The school district that leases buses has a clause that variable payments must be made based on miles driven. Should some portion of the variable payment be included in the lease payment?
Give everybody a quick minute to think about that. And remember, if you watch CPE, we just need you to make sure that you're addressing those poll questions. Okay. All right, so we'll jump into this next section on disclosure. As we mentioned before, you've got 4 phases that you really need to think about with GASB 87. You got to compile and get all the terms of your various leases. Then you got to take those once you've identified them and value them. Then you've got to account for them and provide the accounting, which Heather had gone over before a little bit on how to record those. And then the last step is you've got a disclosure, additional disclosure that's required in your financial statements. So we've got a couple examples here. In this first example, note 6 leases, you can see how they've broken down different types of, so parks, building, computer, the terms that are there, 5 years, payment amounts, interest rates, your total lease liability, and then the balance. So the total lease liability is your initial, and the balance that's left over in your current year, that's what your total balance is. So you can aggregate these, and we highly suggest that you do aggregate them by similar types of assets. So here they have buildings, computers, you might have vehicles. You don't have to list every lease, but you need to aggregate them together, determine what the amounts are. The interest rates most likely might be a range, right? If you've aggregated them together, they may be multiple interest rates. But you've got to provide those. Those should agree back and reconcile to your statements, okay? So that 306 they're showing there, 306,959, hopefully if you went back, it would show that you've got that same amount on your balance sheet. You also, for the different types of leases, you've also got to give a description, a short description of what they are, what they're for. So here they noted the Parks building was leased for a community center until the city can construct a new facility that was destroyed by a tornado. The lease can be renewed for an additional 5 years, but the city does not anticipate renewing for an additional term. Or if your case was that you would be, or you anticipated, you would put that in there. The interest rate on the lease is variable based on the prime interest rate as of July 1st each fiscal year during the term of the lease. So here's where you're going to put all that information. You know, the top table just sort of shows you a snapshot of what are the terms, what's the value of it, what do you have on your balance sheet. And then you have to go ahead and describe what these types of leases are, what the terms on them are. The level of aggregation that you use is somewhat going to depend upon getting to that disclosure, right? Can you, if you aggregate too much, can you put all that in one footnote, or do you really need to, or one paragraph, or do you really need to have sort of a similar or additional breakdown to be able to better describe each type of lease? The computer equipment they noted there, again, what it's for, if it's for a certain department, you know, what the interest rates are again, what the term is, all of that stuff has to be in there. And then the last piece of it is similar to what you have right now. If you had a capital lease or if you have debt, is you've got to show the 5-year individual year principal and interest amounts, and then every 5-year thereafter, similar to what you have with debt. And I know some entities don't normally have to record debt. Most of our community colleges don't record it. We don't really see it with many BOCES, although if you have installment purchase agreements, so you may have those in there, or some GASB debt. So now you've got an additional disclosure that you really haven't had to provide before. But it's similar to all the debt disclosures that you're used to seeing. And so this is just sort of an example or a snapshot of what you would get to in addition to your accounting in your financial statements. And I think we have another example. Yep. So here's another way that it could be done, and another example where the first paragraph they talked about the leasing operations consist of the leasing of office and terminal space. So they know some of the different types of things they have. The second paragraph talks about the cost of some lease space is not determinable because the leased portion of assets are not significant to the total square footage. Now, that brings up a good point. In this standard, as in all standards, they talk about materiality. So you do need to look at, from a materiality standpoint, how much these leases are. I think you will find as you aggregate them and you compile all the leases, you probably have more than you really think. Especially we think about BOCES and schools. They work a lot together in providing those types of equipment purchases. So they may have a little back and forth there themselves. You can see similarly at the end here, you've got your 5-year maturity as well as your every 5 years after that. So you're going to have that type of presentation. All right, so some best practices to think about when you're preparing for the leasing standard. You know, take inventory of your leases. You know, contact any component units and other departments outside of the finance office. We talked before about your discretely presented and blended component units. If you have component units, I'm thinking community colleges, towns, cities, counties, we see this with. If you've got component units, you should be reaching out to them now to ask them if they have any of these reporting requirements and if they're ready for it as well, how they're going to report it, because ultimately it's going to roll up into your financials as well. So certainly component units, they're outside of your, your immediate influence. Reach out to them, find out what they're doing. Often their year ends may be different too, so there could be some timing issues there. Reach out to your other departments to find out if they're, I guess the real question you need to ask them all is, are there any other entities' assets that you're using that you don't own, right? I think that's really sort of the way to look at it and find out if there are things that should be recorded that are outside of the business office that you're not aware of. So take inventory of the leases, start determining the impact to the financial statements. Disclosures may be impacted by the standard as well as assets, liabilities on the balance sheet. We mentioned before, from a lessee standard side, not much difference on your fund accounting. You really won't see anything there at the fund level. You will see it on the entity-wide level. From a lessor standpoint, if you're leasing to someone else, office space, vehicles, equipment, there is going to be a little bit of a difference. You're going to record that receivable on your fund basis financial statements, and you're going to amortize that over the shorter of the lease term. And so you will have a different accounting in there. So if you're a lessor, you really need to start thinking right now about how that's going to affect your fund financial statements. Don't wait to implement. The number of leases present both as lessee and lessor will determine how significant the standard is to the government. Again, we've said it over and over again, don't wait to implement. We saw with GASB 84, again, the folks that implemented sooner had a much smoother audit season than those that were implementing at the end of the year. So we would say that most of you, you're going to be looking at this in your next audit. You need to start thinking about it now, and I wouldn't wait to inventory those. The other thing we pointed out earlier, you've got to have a beginning balance, right? So let's assume you're all doing a 1-year presentation. Hopefully, that's all you're required to do. You still need to have that opening balance figure. So you really need to inventory these leases at the beginning of the year and at the end of the year. So if you wait till the end of the year and try and figure out what you had as of July 1st if you're a school, or January 1st if you're a town or a county, it might be a little harder to do. So don't wait. Start looking at these things right away. And then last, sort of akin to what Greg talked about with ARPA before. I mean, don't wait. Ask us to help you. We're more than happy to help. We've already started working with a few different entities. Engage us to assist with the implementation. Everybody's resources are constrained right now. Been a tough 18 months with the pandemic. Let us help you. Advisors at Bonadeo have the tools to assist with determining the overall impact and journal entries associated with the various lease arrangements. We've actually had a team that has developed a tool, an internal tool that we're using that allows us to value those leases. We'll inventory the leases, value the leases, and then present the accounting for it as well as the disclosures. So we absolutely have the ability to help you with that. We definitely think you should consider acting soon, and certainly feel free to bring in somebody like Bonadeo to help. Have a couple questions here. Let's see. Could software licenses be considered a lease? I believe, I'll double check this, but I believe software is excluded from that. So I don't believe that would be. With regards to software, Keely, I guess, yes, you already answered that one. With regards to software, you would have to consider GASB 96. So yeah, so it would be excluded from the lease standard, but you would have to consider it as 96. And then, yep, so Keely further said software is primarily scoped out of 87. It will likely be in your scope as you start to gather inventory for your leases. So, okay. All right, so some resources, GASB 87 leases, comprehensive document with practical examples and tips for implementation. I have the document here. I know that a lot of our clients we've already provided this to, but we have a very comprehensive guide that goes through a lot of these examples. It's a great document. Certainly, if anybody is interested, we'd certainly be happy to provide that to any of our non-clients. Certainly our clients would be given it. Reach out to Bonadeo Government Experts for more information. We also on our website have a ton of articles on both GASB leases, ARPA, all of those types of things. So website's a great place to look for resources as well. And we'd be happy to anybody who hasn't received a copy of that lease booklet that we've created. We'd be happy to provide that to anybody as well. I would also say before you leave today, if in the chat or if you reach out to us subsequently, let us know of other types of programs that we can provide. We anticipate providing several of these in 2022, and we'd love your input to make sure that we understand what everybody's looking for. You know, lastly, connect with our experts. You had a great panel today of people that work in this every day. One of the things that's different about us at Bonadeo, this group works on governmental all year long. We thankfully don't do any taxes. We have other people in the firm that do that stuff. So when you think of being busy January to April 15th, that's not really us. That's our tax folks. So you've got a great panel here. Their contact information is there as part of the slides, both phone numbers as well as email addresses. Definitely feel free to reach out. If there are any questions before as we're looking to see if there are any, Keely, Heather, Greg, any last thoughts before we go out here?
I just want to go back to a question that was asked earlier about the reporting deadline for project and expenditure reports. I hadn't looked at this because of the way that the Treasury put out the updated guidance, but the metropolitan cities and counties with a population below 250 receiving less than 5 million, they are grouped with the non-entitlement units, and I believe that that does push their reports to April 30th. I haven't worked with any of these counties that fall into that, so I hadn't really considered that. But in looking at the original guidance, then yeah, that does make sense.
Yeah, and you know, as with all of these things too, they change quite a bit as well. So you know, a great reason to to be involved with somebody who's looking at these on a regular basis, because what we say today could change tomorrow. So great point, Greg. Thanks for getting back to us on that. Heather, Keely, any last thoughts?
Well, I just saw that someone said, did the Eagles win the poll? And I guess, ARPA and the GASB update and GASB 87 was so thrilling that they're more worried about who won the actual football poll.
Well, you had a tough day. You had a tough day as a Raiders fan yesterday. So
Yeah, I did.
I think the Bills easily won, because when we're talking about who has the best chance to win the Super Bowl, I'll speak as a Bears fan. I don't think it's us, that's for sure. So again, thank you everybody for joining us today. We appreciated your time. Feel free to reach out to us. And thank you. Have a great day.